Imagine for a second that you just walked out of your university midterm exam.
Oh man, the relief of just being done with it.
Right. I mean, you pored over the books, you drank the unnecessary amounts of coffee, and you get your grade back. It is a flawless A+. You are just on top of the world.
Best feeling, you feel completely invincible.
Exactly. But right as you're doing your little victory dance in the hallway, the professor pulls you aside. He looks you dead in the eye and says, enjoy this, because based on what I'm seeing, you are probably going to completely fail the final exam.
Wow. Yeah, that is a brutal emotional whiplash.
It really is. And that whiplash, that exact feeling of intense cognitive dissonance, it perfectly encapsulates the Boston Scientific Q2 2026 earnings call.
That is a remarkably accurate analogy for what happened here.
We have a massive mountain of raw data today, so welcome to this special talk ticker style deep dive. Our mission today is to, strip away all that Wall Street spin.
Right, get rid of the noise.
Exactly. We're going to look directly at the unfiltered financials and give you, the investor, a clear, actionable breakdown of what to actually make of this stock.
It is a fascinating case study in how the stock market actually functions, honestly.
Oh, absolutely.
Because so often, retail investors, they look at a headline on their brokerage app. They see a green beat on revenue and a beat on earnings, and they just assume the stock is going to skyrocket.
Right. Like, why wouldn't it? Green means go.
Exactly. And then when it falls instead, they feel like the game is rigged against them, like someone is cheating.
Yeah, the classic Wall Street conspiracy theory.
But what this specific earnings call reveals, if you really listen to the subtext and the underlying medical product narratives, is that the market is ruthlessly forward-looking. I mean, the past is really just context.
Okay, let's unpack this disparity between the strong Q2 performance and the drastic change in their future outlook. Because, on the surface, Boston Scientific crushed the second quarter.
They absolutely did. On paper, it looks incredible.
Let's dive straight into those data-forward headlines. So for the second quarter of 2026, they brought in a massive $5.442 billion in revenue.
That is a huge number.
It is. To translate that into growth terms, that is up 7.5% on a reported basis and 7.0% on an organic basis.
Right.
And we have to explicitly point out to you that this actually beat management's own guidance, which they had previously set at 5 to 7%. So top line revenue is a clear, undeniable beat.
Yeah, they cleared the hurdle easily on the top line.
Then you look at the bottom line, adjusted earnings per share, or EPS, hit 86 cents. That's a 15% year-over-year growth rate.
Which is fantastic for a company this size.
Exactly. And it clears the top end of their 82 to 84 cent guidance easily.
And, the operational efficiency looked really robust on paper as well. Their adjusted operating margin expanded by 70 basis points to reach 28.4%.
That's a solid margin expansion.
It really is. And if you are tracking cash generation, which honestly is the lifeblood of a medical device company trying to fund future research, their Q2 free cash flow was a very healthy $1.29 billion.
Wow, so over $1 billion in free cash flow.
Yeah, they even finished the quarter with over $500 million in cash on hand, plus a very manageable gross debt leverage ratio of 2.0 times.
Okay, I'm going to push back right out of gate here. We really need to address the elephant in the room.
Go for it.
If I'm an investor looking at these headlines, I'm popping champagne. They beat on the top line, they beat on the bottom line, margins are expanding, they are throwing off over $1 billion in free cash flow.
Right, looks like a slam dunk.
They even just bought back 40 million shares under an accelerated repurchase program, so the company is literally buying its own stock. To the naked eye, this is a phenomenal quarter. Why is there a dark cloud over this call? Why did the stock take such a major breather?
What's fascinating here is that you have to really look at the anatomy of how they achieved that beat. It wasn't purely off the back of, unstoppable product momentum in the hospitals.
Okay, so there's some smoke and mirrors going on.
A little bit. Let's start with that earnings per share beat, the 86 cents versus the 84 cent top end guidance. Management was actually very transparent that this was primarily driven by favorable discrete tax items.
The tax man giveth.
Exactly.
But let's actually explain what a discrete tax item is for the listener. Because companies use this accounting maneuver all the time, right? To make their earnings look slightly better than the underlying operations suggest.
Oh, constantly. So a discrete tax item is essentially a one-off tax benefit or expense. It's recognized in a single quarter, rather than being spread out smoothly over the entire year.
So it's like a sudden windfall.
Right. Maybe they settled an old audit with a foreign government favorably,
Right.
or maybe they realized a capital loss somewhere that shielded their income or benefited from a sudden change in tax legislation.
Got it. So what happened in Boston Scientific's case here?
Well, their adjusted tax rate for the quarter dropped to 10.7%. And just for context, the typical corporate tax rate model is much closer to 21%.
Wait, 10.7%. So they essentially paid half the taxes they normally would in a given quarter.
Exactly half.
Which artificially inflates the amount of profit left over for the shareholders, which pumps up that earnings per share number.
Precisely the issue. I mean, while lower taxes are great for the bottom line in the moment, they are not a repeatable operational triumph.
Right. You can't just expect that to happen every 3 months.
No, you really cannot build a long-term investment thesis on the hope that the accounting department keeps finding one-off tax loopholes. It masks the actual operational leverage of the actual medical device business.
That makes total sense. And we see a similar illusion when we look at those margin numbers, right? You mentioned the adjusted operating margin was 28.4%, which sounds fantastic.
It does sound great.
But if you look at their GAAP operating margin, and just a quick reminder, GAAP stands for Generally Accepted Accounting Principles. Those are the strict, standardized rules that don't let you just strip out inconvenient expenses.
The rules that keep them honest.
Right. Their GAAP margin was actually only 21.6%. That is a massive 680 basis point difference.
Yeah, and just to put that in plain language, a basis point is 1/100th of a percentage point. So 680 basis points is a 6.8% gap between the adjusted margin they really want you to look at and the GAAP margin required by regulators.
That is a massive discrepancy. And the reason for that gap is that the 28.4% adjusted number excludes a $75 million charge related to product liability cases.
Which is convenient to ignore.
Exactly. They essentially said, if you ignore the millions we have to pay out for legal liabilities, our margins look great.
Yeah, that's not how it works in reality.
They also included an $80 million refund on previously paid tariffs. So if you strip out the one-time tax wins and the tariff refunds and you add back the legal costs, that EPS beat looks a lot less like a superhero landing. They just happen to have accounting wins at their back for a few weeks.
Which brings us to the revenue itself, because we really need to distinguish between reported revenue and organic revenue. Wall Street analysts obsess over organic revenue.
Okay, let's break that down. You noted the reported growth was 7.5%. And organic was 7.0%. They usually throw those two numbers out side by side on earnings day.
Right. So reported revenue is just the raw cash that came in the door compared to last year, converted into US dollars.
Just the literal cash register tape.
Exactly. But organic revenue strips out the noise. It tries to show you the true underlying health of the core day-to-day business.
So what kind of noise are we stripping out here?
Two major distortions usually: foreign exchange rates and acquisitions. In this specific quarter, Boston Scientific had a 50 basis point tailwind from foreign exchange. Because they sell medical devices all over the world, right? They're constantly converting euros, yen, and pounds back into US dollars.
Right, because their stock trades in dollars.
Exactly. So if the dollar weakens against those foreign currencies, the revenue from overseas suddenly translates into more dollars, even if they didn't sell a single extra stent or catheter.
Oh, wow. So they effectively made an extra $28 million purely off currency math.
Just off the math.
Yeah.
Furthermore, organic revenue strips out the impact of recent acquisitions where there isn't a full year of comparable sales yet.
Right, because if you just bought a company that makes $100 million a quarter, your reported revenue shoots up, but it doesn't mean your existing sales team is performing any better.
Exactly.
Yeah.
Wall Street focuses on organic growth because it tells you if the products the company actually invented and currently sells are gaining traction with real doctors.
So even on an organic basis, 7.0% growth is at the very top end of their 5 to 7% guide. That's undeniably a solid number for a company of this size.
It really is. It's a great number.
But this circles back to the core premise of our deep dive today. The stock market is a forward-looking mechanism. Q2 earnings are a trailing indicator. It's like looking in the rearview mirror.
Precisely. You can admire the 7% organic growth all you want, but if you don't look out the windshield, you are going to crash into the guidance revision parked right in front of you.
Yeah, and if you look under the hood at the specific business units, you immediately see why the market got spooked. This quarter was very much a tale of two portfolios.
It really was.
Let's dissect the anatomy of this revenue, starting with the foundation of the house. Because amidst the panic, we have to acknowledge that a huge chunk of this company is operating flawlessly.
Yeah, management was very careful to point out that 75% of Boston Scientific's business is reliably growing at about 6%.
Which is incredible consistency.
It is. That is a remarkably stable base for a massive global medical device conglomerate.
They're far from a one-trick pony. This 75% chunk includes heavy hitters like interventional cardiology, endoscopy, and neuromodulation.
Right. Let's look at neuromodulation, because that grew a stunning 12% organically.
12%? That's huge.
Yeah, they saw double-digit growth in both the pain and brain segments.
Okay, neuromodulation is arguably one of the most fascinating spaces in modern medicine right now.
Oh, it's basically sci-fi.
Seriously, we are talking about implantable devices that interface directly with the human nervous system to alter nerve activity.
Right. So in the pain segment, they're utilizing spinal cord stimulators. These are literally devices that send mild electrical currents to the spinal cord to interrupt pain signals before they reach the brain.
Which is a massive, highly critical market right now, especially as the global medical community desperately tries to move away from opioid reliance for chronic pain management.
Absolutely.
Yeah.
And a key driver for the segment's growth was their integration of NALU. That's an acquisition they made, which contributed a full quarter of performance and is scaling very rapidly.
Got it. Then you transition to the brain segment of neuromodulation. They highlight differentiated products here, like their Cartesia leads and deep brain stimulation, or DBS systems.
Yeah, and this is where we really cross into that sci-fi territory you mentioned.
Oh, 100%. Deep brain stimulation involves implanting electrodes deep inside specific areas of the brain to treat movement disorders like Parkinson's disease or essential tremors.
It is incredible to watch.
It really is. Patients who suffer from these debilitating tremors, they can just turn on a patient controller and the electrical impulses literally smooth out their motor functions in real time. It is life-changing technology.
And nothing short of a miracle for those patients. And it is seeing robust global adoption.
Right. And beyond the nervous system, you have their endoscopy business, which grew 7%.
Yeah, a major highlight here was the Axio stent, which continues to just outperform their internal models. But more notably, they just received FDA clearance for a new device called Revos.
The Revos clearance is a perfect example of how device companies win over hospital administrators, not just doctors.
That's a really good point.
Revos is a single device design meant to consolidate multiple surgical exchanges during endoscopic procedures.
To understand why that matters, think about the actual mechanics of an endoscopic surgery.
Okay, picture this.
A doctor is threading a camera and tiny tools through the body's natural pathways. If they need to cut tissue, then place a stent, then suture. They traditionally have to withdraw one tool, thread a new one down the catheter, withdraw it, and thread another.
It's just a constant swapping out of parts.
Exactly. Every single exchange takes time. It introduces a slight risk of complication and requires the surgical staff to coordinate multiple sterile instruments.
Revos streamlines all of that by building multiple functions to a single device. And hospital administrators absolutely love this because saving steps in surgery saves time.
And time is quite literally money in an operating room.
Exactly. We will talk more about hospital economics later in this deep dive, but if you can shave 10 minutes off a procedure, you might be able to fit one extra surgery into the daily schedule.
Which is massive for the hospital's bottom line. We also saw strong performance in their interventional oncology and embolization business. That grew 12%.
Another double-digit winner.
Yeah. Management highlighted a real-world study called Proactive for their TheraSphere product.
Okay, what does TheraSphere do?
TheraSphere utilizes these tiny glass beads filled with radioactive isotopes. They are delivered directly into the blood vessels that feed liver malignancies.
Wow, so highly targeted radiation.
Exactly. And the Proactive study demonstrated highly meaningful survival outcomes, even for patients with very advanced tumors.
So across the board, treating chronic pain, stabilizing Parkinson's tremors, streamlining endoscopy, and delivering targeted radiation to liver tumors, the core 75% foundation of Boston Scientific is incredibly solid.
It's bulletproof. They are innovating, they are executing, and they are generating cash.
If the entire company operated like that 75%, this earnings call would have been a massive victory lap and the stock would have surged.
No question about it.
But we have to address the remaining 25% of the portfolio. This brings us to the first major crack in the armor, and it is a massive one. Watchman.
Yeah. Watchman.
For the listener who doesn't spend their weekends reading cardiology journals, let me explain exactly what Watchman is, because Wall Street models have been hyperfixated on this single product for years.
It's been the golden goose.
Watchman is a tiny device designed for stroke prevention, specifically for patients suffering from atrial fibrillation, commonly known as AFib.
And AFib is essentially an irregular heartbeat. It is incredibly common as populations age.
Right. When your heart is in AFib, the upper chambers aren't squeezing effectively, they are kind of quivering. And because they aren't pumping smoothly, blood can pool in a small, thumb-shaped pouch in the upper left chamber of the heart.
That pouch is called the left atrial appendage.
Exactly. And whenever blood pools and sits still in the human body, it tends to clot.
Which is very dangerous.
If a clot forms in that appendage, breaks loose, and travels up into the brain, it causes a devastating ischemic stroke.
So the traditional standard of care for decades has been prescribing oral anticoagulants, basically blood thinners like Eliquis or warfarin.
But blood thinners alter your body's ability to stop bleeding anywhere.
Right.
If you are an elderly patient on a blood thinner and you slip and hit your head, a minor bump can become a fatal brain bleed. Even routine gastrointestinal issues can become life-threatening hemorrhages.
It's a scary trade-off for a lot of people. So the Watchman device was introduced as a mechanical alternative.
A physical fix instead of a chemical one.
Exactly. Instead of thinning the entire body's blood, a cardiologist snakes a catheter up through the femoral vein in the leg, across the septum of the heart, and deploys this tiny parachute-like device directly into the opening of the left atrial appendage.
It just plugs the hole.
It plugs the hole. Over a few weeks, heart tissue actually grows over the Watchman, sealing off the appendage entirely so clots can never escape.
It is a brilliant, highly effective, and incredibly profitable device. Historically, it has been a massive growth engine, really propping up Boston Scientific's valuation.
But that engine is suddenly sputtering. I mean, in Q2, global Watchman growth was only 4%.
4%? Wow.
And in the United States, it was a measly 3%. For a product that Wall Street modeled as a high-flying double-digit growth story, 3% is an absolute disaster.
So what happened here? Did the device stop working? Did they encounter like a massive manufacturing defect?
No, the physical device is perfectly fine. Actually, management estimates they still command a staggering 91% market share in this specific category.
91% is a monopoly.
It practically is. The issue isn't the hardware at all. It's the clinical data surrounding the entire treatment space. Management pointed directly to, quote, compounding clinical evidence public over the last 9 months that has fundamentally altered doctor referral patterns.
Okay, so the doctors are changing their minds based on new studies.
Exactly. They specifically named 3 major trials. Ocean, Closure, and Champion.
This is a crucial dynamic for investors to grasp about the medtech sector. In software, a product might slump because of a clunky user interface or a server outage.
Right, or a bad update.
In consumer goods, it might be a supply chain glitch or a terrible marketing campaign. But in medical devices, clinical data acts as an immediate gravitational force on the financials.
It really does.
A single academic paper published in a medical journal can completely rewrite your cash flow models for the next 3 years.
And Boston Scientific's chief medical officer, Dr. Ken Stein, addressed this shift brilliantly on the call. The Ocean, Closure, and Champion trials all essentially investigated the nuanced risk-reward profiles of treating various types of AFib patients.
So they were digging into the granular data.
Right. And what these trials highlighted was that for certain patients, what Dr. Stein referred to as soft indications, the statistical benefit of implanting a permanent mechanical device might not significantly outweigh the risks compared to other management strategies.
Let's define a soft indication for you guys, because this is where the money is being lost. Historically, a hard indication for a Watchman implant is a patient who has a severe medical contraindication to blood thinners.
Like they physically cannot take them.
Exactly. Maybe they have a history of severe internal bleeding or a lifestyle that makes blood thinners incredibly dangerous. For those patients, Watchman is a clear necessity. There's no debate.
Right. But a soft indication is a patient who just doesn't really want to be on blood thinners.
Yeah, maybe they don't like the daily pill routine, or they worry about minor bruising, or they just have a slight hesitation.
Previously, a cardiologist might eagerly refer that soft indication patient to an electrophysiologist for a Watchman implant right away.
Just to get it over with.
Yeah.
But now, armed with the nuanced data from those new clinical trials, referring doctors are changing their behavior. They're looking at these soft indication patients and adopting what Dr. Stein called a wait and wait strategy.
The wait and wait strategy. That has to be the most terrifying phrase a medtech executive can hear.
I can't even imagine.
Because a patient who is waiting is a patient who is not generating revenue today.
Nope.
The doctor is essentially saying, let's monitor your AFib, try to manage it conservatively, and hold off on the permanent implant unless your situation actively deteriorates.
This creates a severe cascading effect on the sales funnel. If the referring cardiologists, the frontline doctors who spot the AFib in routine checkups and send the patient to the surgical specialist, if they start hesitating, the pipeline of standalone Watchman procedures dries up almost instantly.
It's an immediate bottleneck at the top of the funnel.
And we saw that exact dynamic play out in the raw numbers. Standalone Watchman procedures actually saw low teens declines versus the prior year.
A low teens decline for the standalone procedure.
But wait, if standalone procedures dropped that significantly, how did the Watchman franchise still manage to squeak out 3% growth in the U.S. overall?
That growth was entirely propped up by the second major factor disrupting this market: concomitant procedures.
Concomitant. Let's translate the medical jargon again. Concomitant essentially means doing the Watchman procedure at the exact same time as another surgery.
Right, combining them.
The doctor is thinking, well, the patient is already under anesthesia. We already have catheters inside the heart. We might as well plug the left atrial appendage while we're in there.
Yes. Usually, it is performed alongside a cardiac ablation, which is a procedure designed to fix the electrical signals causing the AFib in the first place.
Makes sense to do them together.
The rate of these concomitant procedures grew over 60% in the quarter.
60%.
It has been a shockingly steep adoption curve. Right now, 1/3 of all Watchman procedures in the United States are being done concomitantly.
But if concomitant procedures are up 60%, a rational investor might ask why management is framing this as a severe headwind. I mean, isn't a device sale regardless of when it's implanted?
You would think so, but it comes down to the brutal reality of hospital economics and operating room logistics.
Let's get into this because this is fascinating.
Doing two complex cardiac procedures sequentially during the same surgical block takes significantly longer.
Right.
It requires coordinating different equipment, sometimes bridging different specialists in the room, and crucially, it ties up an operating room for an extended period. Management noted that this rapid shift has created severe, quote, inefficiencies in the system.
Let's paint a vivid picture of these inefficiencies because this is where the financial rubber meets the road. Operating rooms are the economic engines of a hospital. They are often billed internally by the minute, sometimes upwards of $60 to $100 per minute in overhead costs. A hospital administrator's entire job is maximizing the throughput of those ORs. They want predictable, efficient surgeries scheduled back to back.
Right, like an assembly line.
Exactly. So if a scheduled 1-hour ablation suddenly turns into a 2-hour ablation plus Watchman procedure, it throws the entire daily schedule into chaos.
And the hospital administrator sees that the profit margin on the combined procedure isn't necessarily double the profit of two separate procedures.
Because of reimbursement caps from Medicare or insurance, right?
Yeah, but it is taking double the time. So the operational bottleneck forces administrators to push back. They start throttling the schedule, making it way harder for doctors to book these long combination cases.
Oh, wow.
And because the system is jammed up with these lengthy concomitant cases, it actually cannibalizes the scheduling slots that would have gone to the quick, highly profitable standalone Watchman procedures.
It is a perfect storm of logistical friction. The referral pipeline for simple standalone patients is shrinking due to the wait and wait clinical data, and the complex concomitant procedures are jamming up hospital operations, capping volume growth.
Which brings us to the ugly part of this earnings call.
Yes, because Watchman wasn't the only MVP in a slump. We have to pivot to electrophysiology, commonly referred to as EP.
EP is the division that maps and treats the electrical system of the heart, specifically focusing on diagnosing and correcting arrhythmias like AFib.
And what were their numbers?
Global EP grew 9%, which might sound respectable on the surface. But again, if you look at the United States, growth was only 3%.
And to understand why the U.S. market is stalling out, we have to unpack another piece of Wall Street jargon that was dominating this call: PFA.
PFA stands for pulsed field ablation.
Okay, what is that?
To grasp why PFA is causing such massive disruption, you really have to understand the historical context of how doctors performed cardiac ablations.
Lay it out for us.
For decades, if you had an irregular heartbeat caused by faulty electrical pathways in the heart tissue, an electrophysiologist would snake a catheter in and intentionally create tiny scars on the heart wall.
To basically block those errant signals.
Exactly. And historically, they created those stars using thermal energy. They either burned the tissue using radiofrequency ablation, or they froze the tissue using cryoablation. Fire or ice.
Fire or ice. But applying extreme thermal energy inside a beating human heart carries inherent risks, obviously.
Huge risks.
The heart wall is very thin, and right behind it sits the esophagus, as well as the phrenic nerve, which controls your diaphragm. If the heat or cold penetrates too deeply, you can cause severe collateral damage to the esophagus or completely paralyze the diaphragm.
It's terrifying. So doctors have to move very slowly and cautiously to avoid these complications.
Right. So pulsed field ablation, or PFA, completely flips that paradigm. Instead of thermal energy, PFA utilizes extremely short, high-voltage electrical fields.
Sounds intense.
It is, but these microsecond pulses of electricity are designed to cause a very specific biological phenomenon called apoptosis, which is programmed cell death.
And the absolute genius of PFA is that it is tissue selective.
Which means what?
Different types of cells in the body have different thresholds for electrical disruption. Heart muscle cells, myocytes, have a very low threshold. But the tissue of the esophagus and the nervous system have a much higher threshold.
Oh, that's amazing.
Right. So a doctor can deliver a massive electrical pulse that permanently disables the targeted heart tissue while leaving the surrounding esophagus and nerves completely unharmed.
It's just inherently safer.
It is drastically faster, and the safety profile is incredibly compelling.
And Boston Scientific is a massive player in this space. They have the FARAPulse system, which was widely considered the pioneer technology.
They absolutely are the pioneer. The problem they are facing isn't their technology failing. The problem is how violently fast the entire medical community shifted to this new standard.
And how fiercely their competitors flooded the zone.
Exactly. CEO Mike Mahoney made his stunning admission on the call. He stated that the U.S. PFA market has accelerated so rapidly that it has already captured 80% to 85% of the total AFib ablation market.
80 to 85%. That is an overnight revolution.
It really is.
In the medical world, where doctors are notoriously conservative and take years to adopt new surgical techniques, shifting 85% of a market in a matter of months is almost unheard of.
It is entirely unprecedented.
Yeah.
And because the market tipped so fast, the massive entrenched competitors in the cardiac space companies like Johnson & Johnson and Medtronic rushed in with absolutely everything they had to defend their turf.
Because they couldn't afford to lose that share.
Right. Mahoney explicitly admitted on the call, and I quote, "We did not anticipate the degree of competitive share movement we're now seeing in the U.S. market."
Man. So while Boston Scientific remains a leader, they are bleeding market share significantly faster than their internal models predicted.
Yeah, competitors are aggressively bundling their own PFA solutions with mapping systems, offering massive discounts to hospital procurement committees, and just blanketing the U.S. with sales reps.
They just got outflanked.
Boston Scientific simply underestimated the ferocity of the dogfight.
If we synthesize this entire Q2 narrative, the picture becomes incredibly clear. I think the best way to summarize this is with an analogy.
I love a good analogy. Let's hear it.
Managing Boston Scientific right now is like managing an all-star baseball team. You have a lineup of 9 players. 7 out of your 9 starters. Your endoscopy division, your neuromodulation, your interventional oncology, they are all hitting solid singles and doubles.
They're doing their job.
Right. They are giving you a reliable .300 batting average, driving in runs, keeping the team afloat. But your 2 highest paid MVP sluggers, Watchman and EP, the 2 guys who are supposed to be hitting grand slams and justifying your outsized Wall Street valuation, they both went into a massive synchronized slump at the exact same time.
That analogy perfectly captures the dynamic. And the critical insight for you, the investor, is understanding why they slumped.
Right. It wasn't random.
Exactly. The science dictated the revenue. A handful of clinical trials altered the Watchman referral pipeline overnight, and a technological leap in PFA triggered a brutal market share war in EP.
If your 2-star players are slumping, you can't just keep playing the same game and hoping for the best. You have to change the playbook, recalibrate expectations, and restructure your payroll. Which brings us to the most sobering part of the earnings call, management guidance.
Yeah, this is where it got rough.
This is where the apology started and where the major defensive pivot was announced.
The recalibration was severe. This was the exact shock that caused the cognitive dissonance we discussed at the top of the show and what sent the stock into a tailspin. Management slashed their full year 2026 organic revenue guidance down to 5 to 6%.
Remember, they just printed 7% organic growth in Q2. So they are actively telling Wall Street that the back half of the year is going to feature a significant operational deceleration.
They are bracing for impact. Furthermore, they lowered the full year adjusted EPS to a range of $3.28 to $3.32.
And what does that mean in growth terms?
That represents only 7 to 8% earnings growth. For a growth-oriented med tech company that has historically prided itself on consistently delivering double-digit EPS growth, settling for 7% is a bitter pill for institutional investors to swallow.
It gets even more alarming when you isolate the immediate next quarter. The Q3 guide is for a highly muted 3 to 5% organic revenue growth and an EPS of just 80 to 82 cents.
Right, and that Q3 EPS projection is materially lower than the 86 cents they just posted in Q2. They are forecasting a definitive earnings contraction quarter over quarter.
So what is the second half reality that they are bracing for? Like, why are they modeling an earnings contraction?
Management was brutally honest about the assumptions baked into that guidance. For the second half of 2026, they are assuming the global Watchman business will literally shrink.
Shrink?
Yes, they forecast a mid to high single-digit decline for Watchman.
A decline. We are talking about a product that just posted 4% global growth, shifting aggressively into negative territory.
Yes, they anticipate that the phenomenal 60% growth rate in concomitant procedures will slow down drastically.
Why?
Because they're coming up against very difficult year-over-year comparisons from late 2025 when the concomitant boom first started. It is mathematically harder to show massive percentage growth when the baseline number is already huge.
Ah, the law of large numbers.
Exactly. And more importantly, they are assuming absolutely zero improvement in the standalone procedural growth trends. They are modeling that the wait-and-wait referral dynamic triggered by the clinical trials is entrenched for the foreseeable future.
Wow. And what are they forecasting for the EP division?
They expect global EP growth to be completely flat in the second half of the year.
Flat.
Zero growth. They are conceding that the brutal competitive share taking in the US PFA market is going to completely offset any peripheral gains they're making internationally.
You could genuinely hear the contrition in CEO Mike Mahoney's tone during the Q&A segment. I want to read a direct quote from the transcript because you rarely hear Fortune 500 CEOs speak with this level of blunt vulnerability.
It was definitely a rare moment.
He stated, quote, "This update today is not the outcome we planned or what you have come to expect from us. Boston Scientific has had a strong record of growing above our weighted average market growth rates while delivering double-digit adjusted EPS growth. However, market conditions have evolved quickly, and we have been challenged to forecast effectively."
Yeah. That is corporate CEO speak for we completely misjudged the velocity of the market and we got caught incredibly flat-footed.
Yeah, that is a massive mea culpa. But they aren't just standing in the batter's box taking the punches. To survive this slump, they announced a massive, aggressive action plan. And here's where it gets really interesting.
Here we go.
They announced a sprawling corporate restructuring program aimed at delivering $500 million in run rate savings exiting 2029.
$500 million in cost savings. That is not a minor trim. That is a fundamental operational overhaul of the entire organization.
So my question to you, and the question every skeptical retail investor should be asking when they hear the word restructuring.
Right.
Are they just slashing jobs and cutting administrative costs to artificially prop up the balance sheet and save face for the next few quarters? Or is there an actual long-term strategic vision behind this $500 million?
It is definitively the latter. And this is where looking at the broader strategic board is vital. The $500 million isn't just about padding the bottom line so management can hit their immediate bonus targets.
Good to know.
It is a highly defensive maneuver designed to protect their future pipeline. John Monson, the CFO, detailed that the savings will come from global supply chain optimization, functional transformation, which usually means consolidating redundant corporate roles, and organizational structure evolution.
Lots of corporate speak there.
Right. But crucially, he noted they will target S&A selling and administrative expenses first, and then tackle COGS, or cost of goods sold, in the later years.
Okay, let's break down that acronym soup. Why is it so critical that they aggressively cut S&A right now, rather than just trying to manufacture the devices cheaper?
Because they desperately need to protect their R&D budget, research and development. Throughout the call, management kept pointing to the year 2028 as the promised land.
2028.
Yeah, they are building a financial bridge to 2028. They are currently funding massive clinical catalysts that will unlock an estimated $25 billion total addressable market, or TAM, over the next 2 to 3 years.
Okay, so they need the cash to keep funding the future.
Yeah, exactly. If they don't ruthlessly cut costs in administration and sales today, the margin compression from Watchman and EP would force them to cut research funding, and cutting R&D would completely kill the 2028 investment thesis.
So what exactly is waiting for them across this bridge in 2028 that justifies all this painful financial maneuvering? Let's dive into these catalysts because the science here is staggering.
There are several massive catalysts concentrated in the ICVTX sector, interventional cardiology and peripheral interventions. First, you have the pending Penumbra acquisition.
Right.
They're buying Penumbra to absorb their highly differentiated portfolio of thrombectomy devices.
Remind me what those do.
They're tools designed to physically extract blood clots from arteries and veins. The deal should close in the second half of 2026. However, John Monson openly admitted that Penumbra will be slightly dilutive to earnings initially as they execute the integration.
Let's clarify what dilutive to earnings means for a shareholder.
Good idea.
It means that in the short term, the costs of acquiring the company, paying off its debt, integrating its sales force, and aligning its manufacturing, all of that will actually cost Boston Scientific more money than the new products bring in.
Exactly right.
It will act as a drag on their profit margins through 2027 before the synergies kick in and it becomes accretive or profitable.
Yes, it is a short-term pain for a massive long-term gain. Then you look at their entry into the IVL market, intravascular lithotripsy.
IVL is fascinating.
This is a multi-billion-dollar market currently dominated by competitors, and Boston Scientific is preparing to launch their seismic force catheter in the first half of 2027.
I really am fascinated by IVL. Traditionally, if an artery was clogged with hardened, calcified plaque, doctors would inflate a high-pressure balloon inside the artery to crack the calcium open.
Which sounds a bit brutal.
It is, because inflating a rigid balloon hard enough to break calcium can tear the soft arterial wall, causing massive complications.
Right, so what does seismic force do?
Seismic force utilizes sonic pressure waves lithotripsy. It emits pulses of sound energy that travel safely through the soft tissue but violently crack the rigid calcium deposits, allowing the artery to expand safely. It is the exact same physics used to break up kidney stones, miniaturized onto a cardiac catheter.
It is an incredible technological leap. And beyond IVL, there's the MIRIS investment. Boston Scientific strategically invested $1.5 billion into a private company called MIRIS.
$1.5 billion, that's a huge bet.
It is. MIRIS has developed a highly differentiated TVR valve transcatheter aortic valve replacement.
And the aortic valve is the main gatekeeper regulating blood flow from the heart out to the rest of the body. Replacing it without cracking the patient's chest open, doing it percutaneously through a catheter, is one of the most lucrative and fiercely competitive markets in all of medtech.
And it is a market Boston Scientific historically struggled in. But if the ongoing clinical trials for the MIRA valve go well, Boston Scientific holds the exclusive option to acquire the entire asset outright.
Oh, wow.
Essentially parachuting back into the massive TVR market with a next-generation product.
What about the EP division, the division currently bleeding market share in the PFA war? Are they just waving the white flag and giving up that market to Johnson & Johnson and Medtronic?
Not at all. This is exactly why the R&D protection is so crucial. They are pouring money into their next-generation systems.
So they're fighting back.
Big time. In 2027, they are scheduled to launch FARAWAVE Ultra, which is a highly advanced, high-density mapping and ablation catheter designed to reclaim that lost PFA market share.
And what else?
Furthermore, they are entering the ICE imaging market, intracardiac echocardiography.
That's the ultrasound, right?
Yes. ICE involves threading a tiny ultrasound wand directly into the heart to provide real-time 3D imaging during these complex ablations. It is a billion-dollar market they currently have zero presence in.
Massive opportunity.
And by 2028, they anticipate launching FARAFLEX, a novel, large, focal ablation catheter that is currently undergoing rigorous clinical trials.
So when CEO Mike Mahoney says they are aiming to return to differentiated financial performance in 2028, they aren't just crossing their fingers and hoping the macroeconomic weather improves.
Oh, absolutely not.
They have a very specific, heavily funded, multi-billion-dollar product pipeline that they are actively shielding from the current margin storms.
Precisely. They are willingly sacrificing near-term EPS growth, initiating a $500 million restructuring, and absorbing acquisition dilution, all to ensure they have the war chest necessary to launch these game changers.
So what does this all mean? This brings us to the final and most critical mandate of our deep dive. We promised an actionable, opinionated verdict on this stock. Is Boston Scientific a bullish or a bearish signal for your portfolio right now?
To answer that, we really have to bifurcate our conclusion based entirely on your specific investment horizon.
Okay, let's start with the short term.
If we look at the short-term verdict, which I would categorize as the next 12 to 18 months, essentially carrying an investor through the end of 2027, this is undeniably a bearish show me story.
A show me story. In Wall Street terms, that means the company is currently sitting in the penalty box.
Yes.
When a CEO explicitly admits on a public earnings call that they severely misjudged the market dynamics on two of their biggest growth engines, institutional investors pull back. Management has lost a degree of forecasting credibility.
They have to actually put points on the board and prove they can accurately model their business again before the market gives them the benefit of the doubt.
And if you just look at the raw financial math for 2027, it simply does not support a massive breakout in the stock price.
No, it really doesn't.
You have the continued margin pressure from the Watchman division as they undertake the slow, grueling process of re-educating referring doctors and trying to shift those entrenched referral patterns.
Plus the EP division fighting a bloody, margin-compressing trench war for PFA market share.
Right. And you have the immediate EPS dilution from integrating the Penumbra acquisition.
Not to mention the upfront severance and operational costs of executing a $500 million restructuring plan.
Yeah, Travis Steed, an analyst from Bank of America, actually asked management point blank on the call about their EPS growth expectations for 2027. And management conceded that it will be, quote, limited.
Limited. That's not what investors want to hear.
Improving their overall operating margins will be a massive challenge due to the gross margin pressure dragging down Watchman and EP. So if you are a momentum trader looking for immediate fireworks or hoping to trade a quick post-earnings bounce, Boston Scientific is highly likely to frustrate you over the next year.
But, and this is a massive pivot, let's examine the long-term verdict.
Okay, lay out the bull case.
If you are a patient investor willing to hold the stock for 2028 and beyond, the underlying thesis remains highly intact. And I would argue the current pullback presents a deeply bullish setup.
The foundational strength is undeniable. Remember that 75% of the business growing reliably at 6%.
The endoscopy tools, the neuromodulation spinal implants, the interventional oncology radiation therapies.
Right. These are deeply entrenched, high-margin, cash-generating engines that provide a massive floor for the stock. They are insulating the company from total collapse.
And that $25 billion TAM pipeline is just waiting to be unlocked. Between the seismic force IVL launch, cracking arterial calcium,
the potential MIRIS TAVR acquisition, redefining heart valve replacements,
the hypertension trials that are enrolling patients right now,
and the next generation Farapulse ecosystem fighting back in the EP space, they have constructed a massive coiled spring.
So what does this all mean for you? It means patience is paramount. Wall Street algorithms absolutely hate uncertainty.
They despise it.
Institutional fund managers hate not knowing exactly when the Watchman or referral patterns will stabilize or exactly which quarter the EP market share will finally bottom out. That acute uncertainty is exactly why the stock is taking a breather right now.
But if you have a multi-year time horizon, you look at the underlying science, the demographic megatrends of an aging global population requiring increasingly complex cardiac care, and the strategic acquisitions, the 2028 setup is remarkably compelling.
This raises an important question, though, because absorbing all this knowledge is only valuable if it translates into actionable behavior for your broader portfolio.
What is the grand takeaway here?
The actionable lesson here, the real takeaway that you can apply to every single stock you analyze moving forward, is to never blindly buy a company based on a trailing quarterly beat.
It's just looking in the rearview mirror.
Exactly. A flashy headline on CNBC that says Company X beats earnings by 5 cents is completely and utterly meaningless if the underlying product narrative is shifting beneath their feet.
You have to read the earnings transcripts.
You have to research what the competitors are launching.
Yeah.
You have to deeply understand why a product is selling today, not just rely on the fact that it sold yesterday.
You can't drive a car at 80 miles an hour looking only in the rearview mirror, and you can't invest in healthcare looking only at trailing Q2 financials.
Which leaves me with a broader, somewhat provocative thought to mull over, looking at the macro evolution of the entire medtech industry.
I'm intrigued. What is it?
Historically, medical device companies enjoyed incredibly long, stable product life cycles. It took years, sometimes a decade, for conservative doctors to fully adopt new surgical procedures.
And once they were trained on a specific device, they rarely switched.
Right. It was a slow-moving, highly defensive, almost sleepy sector of the market.
A sector protected by massive regulatory moats and entrenched hospital relationships.
But look at the sheer velocity of what we just analyzed today. We saw an 85% market adoption of pulsed field ablation practically overnight, rendering legacy thermal ablation technologies almost obsolete.
It's dizzying.
We saw a single batch of clinical trials. Ocean, Closure, Champion instantly altered doctor referral patterns globally, stalling a multi-billion-dollar Watchman growth engine in a matter of months. MedTech is starting to move at the speed of software.
That's a great point, the speed of software.
The innovation cycles are aggressively shrinking, and critical clinical data is being disseminated globally on social media and medical forums in real time.
That is a wild paradigm shift for investors to internalize. It begs the question, will the future of medical investing require us to trade these massive device companies with the same aggressive agility and intense caution that we use to trade consumer electronics companies?
It really does.
I mean, if a new smartphone release can make last year's model obsolete in 6 months, are we rapidly approaching an era where a novel catheter or a single clinical data drop can do the exact same thing to a medical conglomerate?
It is a dynamic that every healthcare investor needs to grapple with. The defensive moats around these legacy products are shrinking, and operational agility is going to be the new premium valuation metric on Wall Street.
So the next time you see a medical device company post a flawless A+ on their quarterly exam, just remember to ask yourself, what exactly is waiting for them on the final? Thank you for joining us on this deep dive into the corporate transcripts. We hope you take these analytical tools and apply them rigorously to your own portfolio research. Until next time.